Carlos was 48, earning $25 an hour as a licensed electrician. He had worked a standard Model 2080 paid hours during the year, producing $52,000 of gross pay, but he had $0 in retirement, $1,140 in cash, and $18,300 on a credit card at 22%. He had 19 years until age 67. Carlos was not short of effort. His financial system was converting each hour into less usable progress than the wage label suggested. That is the time sale tax. The time sale tax is not a government levy. It does not include every payroll tax, ordinary living expense, or dollar Carlos chooses to spend. It is the pressure created when required work costs reduce usable pay, revolving interest converts past spending into future labor hours, and the main path to more income is adding hours to a finite week. This video will show those three mechanisms and the plan Carlos used to change the value and assignment of his next hour. Carlos is a fictional composite. His wage, costs, debt, payment plan, and future balances are illustrations. The federal guidance and occupational data are real. Carlos works for an electrical contractor in Jacksonville, Florida. The Bureau of Labor Statistics says electricians install, maintain, and repair power, communications, lighting, and control systems. It also notes that electricians face injury risks, commonly work full-time, may work evenings and weekends, and often work overtime. The work requires skill, attention, protective equipment, and physical presence. Carlos cannot repair a panel from a spreadsheet at home. For this fictional model, his monthly take-home after payroll deductions and employee benefits is $3,420. Actual take-home depends on taxes, benefits, filing status, location, and household facts. His personal commitments, no non-monthly costs, and scheduled $470 card payment total $3,100 a month. His reliable margin is $320. The first-time sale tax mechanism is work cost drag. Carlos's posted wage is $25 an hour, but some costs exist only because he performs this specific work. He tracks $1,100 a year for required protective equipment, work boots, and tools not supplied or reimbursed by his employer. He also tracks $2,080 of incremental job site travel beyond his ordinary commute. That travel figure excludes personal driving and the commute he would normally make to a regular workplace. Carlos is audited, unreimbursed required work costs total $3,180 a year. Divided by the Model 2080 paid hours, that is about $1.53 per paid hour. His pre-tax job cash rate after those specific costs is approximately $23.47. That is not his tax rate and not a claim that every electrician has the same expenses. It is a compensation measurement. The wage label shows $25. The job cost file shows how much of that wage remains before payroll deductions and household bills. Carlos does not assume those costs are tax deductible. He does not assume the employer must reimburse them. He checks the written employer policy, union agreement if applicable, job assignment, and current tax rules before treating any cost as reimbursable or deductible. The mechanism is not that all work expenses are unfair. The mechanism is that an hourly wage is easy to compare while the required cash cost of earning it is often scattered across statements and receipts. The second mechanism is debt hour conversion. Carlos's $18,300 card at 22% creates a simple monthly interest scale of $335.50. That is $18,300 multiplied by 22% and divided by 12. It is not a prediction of his next statement. The Consumer Financial Protection Bureau explains that many card issuers calculate interest daily using an average daily balance, billing cycle length, daily balances, fees, new charges, and payment timing can change the actual amount. The scale translates the pressure into Carlos's unit of exchange. $335.50 divided by his $25 gross wage equals 13.42 hours. If the balance stayed near $18,300 for a full year, the annualized interest scale would be $4,026. That equals 161.04 gross labor hours, or approximately 4.03 40-hour work weeks. Again, that is a constant balance scale, not a payoff forecast. As Carlos reduces principal, the modeled interest falls. Dead hour conversion means yesterday's balance places a claim on tomorrow's hours before those hours can fund retirement. The third mechanism is the hour ceiling. 2080 is a model in convention for 40 hours across 52 weeks. Carlos can work overtime, but a week still has a fixed number of hours, and his trade still requires attention and physical capacity. More hours can increase gross income. They do not remove work cost drag or dead hour conversion automatically. The Bureau of Labor Statistics identifies advancement routes inside the trade. After meeting additional requirements, journey workers may advance to master electrician. Electricians may also move into supervisor or project management roles. Requirements vary by state and locality, and additional certifications can demonstrate competency in fields such as solar photovoltaic, generating systems, or lighting. None of those paths guarantees a promotion, business, or income increase. They reveal the correct question. Instead of asking only, how can Carlos sell more hours, the plan asks, which verified skill or responsibility could raise the value of an hour he already sells. Carlos's repair begins with a total compensation file. He writes down the hourly wage, expected paid hours, overtime rules, health coverage, retirement match if any, paid time off, travel expectations, supplied tools, safety equipment, training support, and reimbursement policy. He compares job offers using the complete file, not the hourly number alone. A job paying $1 more can still produce less usable cash if required travel, equipment, or benefit costs are materially higher. A lower posted wage can sometimes have greater total value if benefits, match, training, or paid time are stronger. This is a comparison method, not a universal conclusion. Carlos then creates a required work cost ledger. He records only documented job-specific costs. Personal driving stays personal. Ordinary commuting stays separate. Employer-supplied or reimbursed items do not remain in his cost total. He asks the employer or union in writing whether any tool allowance, protective equipment program, travel policy, or paid training applies. The answer may be yes, no, or conditional. His base plan assumes no new reimbursement. That ledger blocks work cost drag by making total compensation visible without inventing a tax deduction. Next, Carlos addresses debt hour conversion. He begins with $1,140 in cash. He keeps $1,000 as a personal starter reserve because missed work and tool or vehicle problems could interrupt his income. $1,000 is not a universal emergency fund rule. Someone with dependents, unstable housing, medical needs, or different job risks may need a different amount. Carlos applies the remaining $140 to the card. The modeled balance falls from $18,300 to $18,160. His scheduled card payment is $470. He adds the reliable $320 margin, producing a total payment of $790 a month. Investor.gov says eliminating high-interest card debt generally offers a benefit that investments are unlikely to match with equal certainty. The model assumes no new charges, a constant 22% annual percentage rate, monthly compounding, and payments at the end of each month. Real issuers may accrue interest daily, so actual statements will differ. The first modeled month adds approximately $332.93 of interest. After 12 payments, the modeled balance is approximately $12,086.92. Modeled interest paid during those 12 months is approximately $3,406.92. Principal reduction from the monthly payments is approximately $6,073.08. Carlos still has the $1,000 starter reserve. His net position improves by approximately $6,073.08. He is not debt-free at month 12. The balance and the number of future labor hours it can claim are both smaller. If Carlos continues $790 a month under the same assumptions, the modeled balance reaches zero in month 31. The final payment is approximately $95.76. Total modeled interest after the initial cash payment is approximately $5,635.76. Those figures are not promises. A new charge, emergency, rate change, fee, missed payment, or different daily balance method will move them. The reserve exists because real life can interrupt a clean model. Carlos's third file is the higher value hour map. He does not enroll in the first expensive course advertised online. He starts with a local licensing board, employer, union or apprenticeship committee, and current job postings. He records the exact prerequisite, study time, exam or training cost, employer support, wage range, number of local openings, and whether the role changes physical demands. He compares master electrician, supervisor, estimator, project management, and specialized certification paths. He also checks employer moonlighting rules, licensing, permits, insurance, and business requirements before accepting independent paid work. The map does not guarantee a higher wage. It prevents Carlos from spending money on a credential with no verified path to value. That blocks the hour ceiling by moving the next decision from more hours to better supported value per hour. Suppose the card reaches zero near age 51. Carlos does not treat the released $790 payment as automatic spending. In one illustration, $600 a month moves toward retirement, while $190 helps expand the reserve and fund verified training. From approximately age 51 to age 67 is 16 years. At 5% annually, compounded monthly, $600 a month grows to approximately $175,946. At 7%, the illustration reaches approximately $211,361. Those are not forecasts. They assume uninterrupted contributions and stable returns before fees and taxes. Real investments fluctuate, and Carlos could finish above or below either illustration. Investor.gov's compound interest calculator asks for a monthly contribution, time, and an estimated interest rate. Estimated is the important word. The Social Security Administration says full retirement age is 67 for people born in 1960 or later. That is a planning marker, not a promise that Carlos must stop working or claim benefits then. Pressure becomes analysis when Carlos stops calling every deduction from his paycheck a hidden tax. He separates required work costs, revolving interest, household spending, payroll deductions, and career development. Analysis becomes relief when each mechanism receives the correct blocker. The compensation file and cost ledger expose work cost drag. The protected reserve and principal plan weaken at hour conversion. The verified skill map creates a path beyond the hour ceiling without promising the result. If you are between 38 and 52 and sell your time for income, write down 5 numbers: your posted hourly wage, your paid hours last year, your documented unreimbursed required work costs, the monthly interest scale on your highest rate debt, and the verified cost and wage range of the next role or credential you are considering. Do not ask only how many more hours you can survive. Ask what prevents the next hour from creating more usable progress. Carlos began at 48 with zero retirement savings, $18,300 of car debt, and 19 years of retirement pressure. At month 12, the debt remains, but the model has reduced principal by approximately $6,073, preserved a starter reserve, and replaced one vague problem with 3 auditable files. The clock still matters. It is no longer the only lever Carlos can pull. That is how he begins blocking the time sale tax.